Hello, welcome to European Open briefing for Wednesday, August the 29th. I'm Rafi Boyajan, currency analyst at XM.com, and we're going to be taking a look at what's happening in the currency markets today. So markets are still in broadly risk-on sentiment. So there was optimism this week on the NAFTA renegotiation after the US and Mexico managed to resolve their differences, and Canada has now rejoined the talks, and we could possibly see a conclusion to those talks in the coming weeks. Despite that, there's still concerns about the US-China trade war, which still there's no sign of that being resolved anytime soon. The dollar yesterday did retreat before heading up again on strong US consumer confidence data. So investors have been unwinding some of their safe haven flows to the US dollar on the back of those growing trade tensions, which have elevated a little bit this week. The Canadian dollar continues to benefit from the optimism of possible NAFTA deal. Yesterday it hit a 3-month high. At the moment, though, it's slightly weaker against the US dollar, with dollar CAD trading around 1.2932 at the moment. If you take a look at the euro, it has fallen back below the 1.17 dollar level yesterday. It rose to 1-month high around 1.1733. There are some concerns about Italy. In next month, we're going to have Italy's government announcing its new budget, which could possibly breach EU rules, and that sent Italian bond yields spiking again. So that is somewhat weighing on the euro, but against the pound, euro pound has in fact reached a fresh 11.5 months high. If you look at sterling against the US dollar, it's also struggling there. It's fallen. It briefly rose above 1.29 yesterday. It's now trading around 1.2870, as at the moment all indications are that the UK could be heading for a no-deal Brexit. The Australian dollar is also struggling against the US dollar. It's currently trading around 0.7310. It came under sudden pressure earlier today after one of Australia's main banks increased its mortgage rate, despite the fact that the RBA has held interest rates unchanged for the past 2 years. So that has raised some concerns that Australian homeowners could be facing higher borrowing costs despite the central bank keeping rates on hold. And in commodities, we can see gold is back above the $1,200 level, though it's struggling to hold on to that. Oil prices, though, are weaker. We did see a surprise build in US inventories yesterday in the API private industry report. If you look at the main movers, we can see the dollar index basically on the back of that consumer confidence data is the main gainer this morning, followed by gold. So we can see that all of those are still very small moves. At the bottom of the table, we've got the Aussie dollar as the worst performer. Taking a closer look at the dollar index, we can see yesterday it did fall to 1 month low, 94.43, but then we had the Conference Board's consumer confidence index, which jumped to an 18-year high of 133.4. That easily beat expectations of 126.7, and we saw the dollar index rebounding a little bit to around 90 to above 94.75. So this week we've had some optimism regarding trade, as the US and Mexico managed to resolve their differences regarding updating NAFTA, and Canada has now rejoined those talks, and the hopes are high that there will be a deal, though there's still some way to go, and even if they do reach an agreement, it's unlikely it will manage to get through Congress before the US midterm elections. So still quite a bit of uncertainty, but a more immediate concern is next week we've got that deadline for the public comment period on that 200 billion worth of Chinese imports that was announced by President Trump earlier in the summer. So if on that deadline the US president decides that he wants to go ahead with those tariffs, we could soon see those additional tariffs on 200 billion worth of Chinese imports coming into effect, possibly in early September, and we could once again see trade tensions creating some market turmoil and possibly a stronger US dollar. Moving now on to the euro, we can see the euro dollar retreating from yesterday's 1 month high 1.1733. So we've seen resistance around 1.1740, 1.1750 region several times in the past. So that's once again proving a strong resistance area. And the reason why it retreated yesterday was on the back of concerns about Italy's new budget, which is in the works, will be announced in September and could possibly breach EU budget rules, which says the budget deficit should not exceed 3% of GDP. So we saw the yield on 10-year Italian government bonds climbing to 3 months highs yesterday, and we saw the euro moving lower as those bond yields spiked, and we saw an increase in the differential between Italian and German government bonds. If you look at against the sterling, the euro is also lower, but yesterday it did manage to hit a near 1-year high of 0.1999. So sterling has been under a lot of pressure recently, as doesn't seem to be any progress in the Brexit negotiations, with many senior politicians, including the Prime Minister, saying that a no-deal Brexit wouldn't be the end of the world. So although that is seen as a negotiating tactic, still the risks are considered to be much higher than it was before in terms of a no-deal Brexit becoming a reality. So sterling there we can see hitting a 1-year low against the euro, and it's now being there's several reports suggesting that the October deadline of the Brexit talks is unlikely to be met, and we could see an emergency meeting being arranged for November. So that uncertainty clearly likely to run well until November. And quick look at the Australian dollar, because earlier today the Aussie briefly slipped below the $0.73 level. So this comes after Westpac, one of Australia's largest banks, raised its borrowing costs on home loans. So this means that households will likely face higher costs on meeting their mortgage obligations. We saw the Aussie recovering a little bit to just above the 0.73 level, but there are concerns that other large banks will now follow suit, and we've already seen smaller banks in Australia raising their mortgage rates. This comes despite the fact that the RBA has held its cash rate unchanged for the past 2 years. So despite the central bank leaving rates on hold, Australian households are facing higher mortgage rates, and this means that the RBA is now likely to raise its interest rates much later than anticipated, which would be negative for the Aussie. And a quick look at today's economic calendar. The main focus will be on the second estimate of US GDP growth for the second quarter. That's it from me. Thank you very much for watching, and have a great day.